Welcome to This Explainer. Today, we're diving deep into the $4.1 billion power sports giant Polaris Incorporated. You know them, right? This is the massive company with a huge cultural footprint. The ones responsible for the ATVs, snowmobiles, and motorcycles that absolutely dominate the outdoors. But right now, well, we need to unpack some extremely, wildly conflicting signals surrounding its stock. I mean, this company is throwing off some of the most contradictory data points in the entire market right now, and we're going to break it all down for you.
All right, here is our roadmap for today. We'll start with the central Polaris paradox. Then we'll rapid fire through 14 crucial red and green flags, run the financials through 4 legendary investor frameworks, and finally, give you the definitive bottom line. Part 1, the Polaris paradox. Because right now, Wall Street is getting some seriously conflicting signals.
To understand this paradox, we have to look at the valuation. Right now, Polaris is sitting at a trailing PE ratio of 39.2x. Now, for anyone new to this metric, a PE of 39 basically means investors are willing to pay $39 today for every single dollar of profit the company made over the last year. Typically, you only see a number that high for, say, hypergrowth tech startups that are totally revolutionizing an industry. Not exactly what you expect for a heavy machinery and power sports manufacturer, right? It points to an extreme overvaluation that usually sends fundamental investors running for the hills. But flip the coin, and on the exact same stock, you've got a juicy 4.96% dividend yield. That kind of yield is a massive magnet. It offers steady passive income that easily beats inflation. So here's the real question. How on earth can a stock be mathematically terrifying to fundamental value investors, yet incredibly alluring to dividend hunters at the exact same time? Well, to understand this intense tug-of-war, we need to rigorously examine the bear case first. Let's get into our 7 massive red flags. When we look at the historical data, the sheer scale of the premium you're paying right now becomes, honestly, a little terrifying. You're paying over 3 times the historical multiple, which usually hovers around a 14.3 median, for a business that's currently sporting a negative 3.46% profit margin and a whopping $260.4 million net loss over the last 12 months. Now, why are they losing so much money? It's pretty straightforward. They're a cyclical business selling highly discretionary big-ticket toys. And in an environment where high interest rates and inflation are absolutely crushing consumer demand, yeah, it's tough out there. And this really brings us to the core of the red flags. Imagine you're looking at a business where sales have just been totally flat over the last 5 years, having peaked back in 2023. On top of that, the free cash flow margin is contracting by about 3 to 5%. But perhaps most alarmingly, think about the insider activity. The CEO and CFO have recently dumped nearly $3.89 million of their own stock on the open market, and 0 people in the C-suite are stepping up to buy. When you combine that mass exit from leadership with a declining return on invested capital, which is really just a fancy way of measuring how well the company uses its cash to make more cash, you absolutely have to pay attention. Add in a tepid hold rating from analysts, and it paints a stark picture of a business deeply struggling to find top-line growth. But hey, Wall Street isn't completely crazy, and institutional money hasn't abandoned ship. So let's pivot to the bull case, the 7 overlooked green flags keeping this stock afloat. The very core of this bull case relies heavily on their 2027 product innovation. Polaris is intelligently attacking their demand problem from both ends of the consumer spectrum. For the adrenaline junkies who want absolute power and frankly do not care about the price tag, they're pushing the limits with machines like the massive 275 horsepower RZR Pro R Boost and that advanced pneumatics expedition technology. Pretty awesome stuff. But they aren't forgetting the budget-conscious rider either. They're capturing the more fragile entry-level consumer with highly accessible utility ATVs, like the Sportsman 500, priced right around $7,000. This dual-pronged strategy is their exact blueprint to try and innovate their way out of this slump. Now combine that strategic innovation with some very reassuring financial guardrails. What you really need to take away here is that the nearly 5% dividend is actually incredibly safe right now. A 32.35% payout ratio means they're using just about a third of their earnings to pay that dividend. That leaves plenty of breathing room, which is a massive sigh of relief for income investors. Add in a GF score of 73 out of 100 with a perfect 10 out of 10 for momentum, showing strong recent buying pressure from its 52-week lows. Plus, you've got massive institutional backing. We're talking 94.2% institutional ownership from giants like Vanguard. Throw in a projected return to profitability by Q2 of 2026 with an 8.8% year-over-year growth and projected revenues of $7.8 billion by 2029, and you can see exactly why this stock still has its fans. So, how do we break the tie between these terrifying red flags and alluring green flags? Welcome to the legendary investor test where heavyweights weigh in. We're going to treat history's greatest financial minds as our ultimate lie detectors to see if this company makes the cut. And when we put Polaris to the test, the picture becomes incredibly definitive. Despite having a recognizable brand, which gives them a narrow moat against cyclicality, the legendary investors issue a catastrophic rejection. Benjamin Graham, the father of value investing, demands positive, predictable earnings and a low PE. Polaris strikes out entirely with 0 out of 7 criteria met. Peter Lynch loves a bargain on growth, measuring it with a PEG ratio where a score under 1 is a steal, while Polaris is sitting at a massive 3.34, meaning you're paying a huge premium, about 10 times the growth rate, for growth that simply isn't there right now. And Warren Buffett, he demands high returns on equity. Polaris is sitting at a disastrous negative 25.57% with no truly durable moat. So yeah, it's a unanimous, absolute rejection from the heavyweights. Which brings us to the bottom line and the final verdict. We've looked at the data from both sides, the bulls and the bears. So what's the actionable takeaway for you? How do you actually apply this paradox? Well, the crucial point is this. Your move depends entirely on your strategy. If you're a Graham, Buffett, or Lynch value investor hunting for the next big fundamental play, walk away. It's a hard pass. Even for deep value contrarians, it's a pass. The valuation and the deteriorating fundamentals just do not align. However, if you're an income seeker relying on steady payouts, that 4.96% yield means this is a solid watch. And if you're a cyclical or discretionary trader who believes the Federal Reserve will drop interest rates to spur consumer spending, then Polaris definitely deserves a consider rating. A drop in rates makes those expensive ATVs affordable again, turning this into a very intriguing cyclical play. As Warren Buffett famously said, price is what you pay, value is what you get. Right now, the price of Polaris is simply completely disconnected from the actual underlying business value you're receiving in return. Ultimately, a prudent investor would want to wait for a significant pullback, targeting that $55 to $60 range before really considering an entry. Because right now, you are paying a massive premium for a struggling business. And that leaves us with the ultimate question. Can Polaris innovate its way to growth, or will that 39x PE ratio absolutely crush it? Keep a close eye on their upcoming quarterly earnings to see if they can convert that cool new 2027 technology into actual profit. Will those shiny new models save the day, or is this valuation a bear trap just waiting to snap shut? Thanks so much for joining me for this explainer. Stay curious and keep learning.